Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is March 25th, 2018 edition of Market Outlook. So we got quite a nasty sell-off during last week. Let's see where that leaves us and where some critical support might hold. So the first thing to note, of course, is that the indices broke down pretty hard, and they all now are under the 50-day moving average across the board in the key indices. Now, obviously, right now you can see that the S&P is sitting right on its 200-day moving average, and actually on a closing basis, it's the lowest close we've had since February. So we had that nasty sell-off, and that is a lower close than we've had even amidst that decline. The same is holding true for the Dow Jones. Now, the two indices that are holding up quite a bit better is NASDAQ, right, which is smartly above the 200-day moving average. So critical support here is coming in around the 152 level in NASDAQ 100. The same can be said for IWM, where there's been a changing of the guard, where I had mentioned smaller caps and the tech sector still strong relative to the larger caps as reflected in the Dow and the S&P. So key support levels here really in the IWM comes in really on the intraday spike around 142. So those are your critical levels. You really want to see on a daily closing basis holding those levels. I would not be surprised, of course, to see a penetration on the weaker indices. But again, what we want to do is make sure we're watching the strongest and see where they hold. Because if the strongest market indices here break down as well, that's going to be your real sign that a lot more is underway on the downside. So again, just to reiterate, breakdown beneath the 10 and the 50-day moving averages to be noted across the board. There's one other thing I want to highlight that suggests that this sell-off may be a little bit more severe on a continued basis, because look at the slope here of our 50-day moving average. You can see in the SPY starting to turn down. Not quite the case back in February. Flattening out, yes. Turning absolutely negative, no. So that is a fresh development. Same thing can be said in the Dow as well, and the IWM sort of flattening. So there you've got the scenario here where you've definitely got underpinnings quite a bit weaker. So just to sum it up, on a price basis, you definitely want to see that 152 area hold in the Qs and 147 area hold in IWM. Now, taking a look at real motion sort of confirms what I had mentioned before. If you take a look at the Dow, our real motion indicator, you can see is the weakest it's been. Now, this chart goes back to uh, about 6 or 7 months into October, November timeframe, and you can see on a momentum basis we're quite a bit weaker. So what was the strongest? Now showing the most amount of pressure. IWM sort of holding up relative to its decline earlier in the year in February. So that's a bit stronger. So right now we're focused on the strongest, looking for it to hold up and offer support to the market. If not, a lot more, we're in for a lot more weakness here as well. So the Dow, the weakest, you can see on a momentum basis, it's definitely the weakest out of the bunch. S&P coming in a close second there, and the other two indices certainly holding up better than the others. Okay, so now let's take a look at some of the key intermarket relationships. Okay, so one thing here is we can take a look at the S&P versus utilities. Obviously, when the S&P underperforming utilities, that's a safety play. Look what's happening here. This is the S&P versus utility intermarket relationship, and you can see the S&P breaking down hard when this red line here, which is the key number, the actual closing basis on a daily basis of the ratio value, and when that crosses under the monthly here, which is that black moving average, that's telling you that the S&P is breaking down relative to utilities, a negative sign showing lack of speculative interest in in the market here. Now, what's also interesting when you look at these type of relationships, it doesn't tell you that the market is bullish for utilities. It's just telling you a relative basis. And as you can see, both of these now are breaking down hard, with the S&P just starting to test its 200-day moving average, stopped on it, where of course we're already below it in utilities. Now that type of scenario seems to be playing out across the board in all of our key intermarket relationships. So just for a quick review here, uh, we can see, right, S&P versus the bonds, this top chart here, also breaking down and about to violate our 6-month uh, relationship as well, right? This blue line here is the 6-month uh, average of the relationship between the S&P and U.S. bonds. You got the same scenario now happening with high yield debt versus bonds. Obviously, when bond players are feeling optimistic about the overall market, they're willing to step in and buy some junk or high yield debt relative to the safety of U.S. bonds, and that is also breaking down, as we can see right here as well. Now, the other thing is that the S&P versus gold, gold definitely outperforming. Obviously, gold definitely a anxiety play, and you can see it got hit really hard this week, this relationship. So across the board, all of our key relationships now that are indicating lack of speculative interest or move to safety. And of course, with the S&P sitting right on the 200-day moving average, that's a new closing low in quite some time. So this is an important situation to monitor. Markets definitely under pressure at the moment. Another key thing to watch here is institutional volume. One of the things that's fairly obvious is you've had virtually no buying over the last 2 weeks, with one exception. The Russell, which we had been pointing out, actually has two accumulation days. Nonetheless, we've had zero accumulation days in the Dow Jones, the S&P 500, and in the Nasdaq over the last 2 weeks. That's telling you institutions or large players not accumulating. And the best that we can do is still a distribution type scenario in the Russell 2000. But on a relative basis, that's holding up better. So again, I reiterate, we're looking at important support around that 142 level. And again, if support's going to show up, that means that this Russell 2000 here should be the first one to exhibit that support. And you can see here, even though it's still overall weak, it's quite a bit stronger than the other indices. Okay, let's take a look at sectors and see if that is also deteriorating along with the market as well. And as you can see, what's interesting here, we have gone from a situation where virtually all the sectors were in bullish phases. You can see we've gone into warning or even worse, distribution phase across the board. We've got nothing that is currently bullish. And with those 50-day moving averages pointing down or starting to slope down, that's a lot more troublesome. And as you can see right now here, we definitely picked up over the last 6 months several more indices that are showing negative movement or negative 6 month uh, uh, results. So that is also a negative. Increased deterioration in the number of sectors that are now in weakened phases. So here you can see this is a chart of the number of phases up versus down. And over the last 2 weeks, we moved where two more key market sectors have deteriorated. That is definitely a negative. So as you can see, attacking the S&P, attacking this 200-day moving average up here. I had put in a couple of weeks ago this trend line. We clearly broke down, uh, broke the trend line, broke the 50-day moving average, and this market is now under pressure. And it's going to be interesting to see just how well the markets hold up here and what it does against the recent lows in February is going to be an important level to watch here in the S&P. So, all right, now let's take a look at one final piece here. And at the moment, the other key thing to note is gold, right, which has sort of been docile, is starting to wake up. It's actually moved into a bullish phase. So whenever there's stress on the markets or extreme stress, people do run into gold. It's still a storehouse or an alternative play to traditional assets. So a couple things here. Gold and oil both moved and are in bullish phases. So that's interesting to note. These two commodity plays interrelated. Gold and oil acting strong during times of stress here is not a positive sign. There have been sell-offs of recent where these two commodities did not do well. The fact that they are is definitely pushing my buttons here, and it goes back to the late 70s where gold really exploded along with oil when there was lots of international tension. Now, the other thing, of course, to note is semiconductors went into a warning phase, right? So that is a pretty good deterioration of what is the leading sector. So definite deterioration across the board. Obviously, technology stocks, internet-based stocks, definitely under pressure with Facebook leading the charge on the downside. So the question remains, is this recent news about Facebook a key turning point for the market and for technology stocks in general? Okay, that's it for now. See you next week. Stay extremely frosty under these conditions and uh, keep an open mind as to how this thing can play out. And again, watching some of this shorter term, uh, uh, how the shorter term plays out, definitely is going to be important because as the market picks up volatility, maintaining your flexibility is crucial during these periods. All right, see you next week. And again, good luck with your trading.